Hi, I'm Josh Young with Bison Interests, and this is an oil and gas market update. Please see this important disclaimer. This is not an offer, solicitation, or recommendation. Just a little about Bison. We invest in publicly traded oil and gas companies with a focus on companies that have survivable balance sheets, quality assets, and good management teams. And I'm the former chairman of the board of a publicly traded oil and gas company in Canada, which we turned around and sold in 2018. So what I'm going to do in this one is go through some perspective on the oil market and then go through a little bit on the gas market and some of what we're seeing in the equities and then wrap it up. And this is something we had prepared originally for a conversation that I had with a founding partner at Oliva Gibbs, which is an energy law firm and land law firm. And we didn't get to go through all these slides, and I thought with a lot of different conflicting news and frankly a lot of negative sentiment, it made sense to share a more comprehensive view on the market. So shale slowing is probably one of the most important facts in the current oil market, and I think it's going to be increasingly important as the impact of reduced oil production growth from shale is felt in the market. Well productivity is declining on a per foot basis, and as you can see from the chart on the top right, as global demand has risen, incremental supply has predominantly come over the past decade from the US. And this raises the question of where it will come from over the next decade as shale well productivity is declining and shale growth is slowing. So one of the negative drivers, or the drivers of negative sentiment right now in the oil and gas market, is the Trump administration coming out and essentially promising lower oil prices, along with a commitment to getting U.S. shale companies to, as they say, drill baby drill, and that this will lead to both more production and will lead to lower prices. However, this is inconsistent with the messaging from the industry, which is not responding favorably to these promises. And then, as you can see from a rig count perspective, the oil rig count as well as the gas rig count are not responding to this promise from the Trump administration. And if anything, with the recent move in oil prices lower, there's actually a risk that this trend of lower rig count for the last couple of years on the oil side may actually continue. From a longer term perspective, oil demand has grown by about 1% a year for the past several decades. And at the same time, over the past 15 or so years, oil capital investment has fallen. It peaked in roughly 2014, and so for the past decade plus it's fallen, and there have been some years where there was extremely low capital expenditure, and we think that the way to think about this is sort of a capital deficit to the tune of over $1 trillion relative to a reasonable run rate even before adjusting for inflation. And so until that investment's made, it's going to be harder and harder for the global oil industry to meet rising demand. And we think that this raises the risk of a price shock at a future point. One of the odder things that we see in the news and in various macro reports, both broad as well as oil and gas specific, is a narrative of oil supply. And frequently people will point to an oil price chart or to materials from various sources that have been unreliable. We thought this was interesting. It was posted on X recently. Thought I'd share it since it was already out in the public domain. It's from Energy Aspects, and they show that oil inventories were actually in significant decline at the start of this year, to the tune of over 1 million barrels a day of global oil inventory decline so far this year. Again, this is very, very different from what you'll see in the news and very different from what the IEA and others have been showing. But it is consistent with what some other groups that measure these things from a satellite perspective and various other measures are seeing. And this is very important to keep in mind as you look at the next slide. So keeping in mind a million plus barrel a day observed oil inventory decline, I think makes it better, I guess more understandable why OPEC would have brought some oil back onto the market. And, oil prices did fall quite a bit after OPEC decided to, or OPEC Plus decided to bring on some additional production and announce that. However, even before that, it looked like there was going to be roughly 1 million barrel a day call on OPEC between lower US production growth versus consensus, as well as reasonable demand growth. And I think it's one of those interesting things where OPEC was waiting for demand pull for their oil. However, I think the market was expecting that it would wait for a price signal from demand pull. And in the current very negative oil market sentiment and positioning environment, OPEC did not receive that. And frankly, their bringing oil back on sort of further hurt sentiment and positioning. That being said, with this call on OPEC versus their current plan, the oil market will likely be in deficit for full year 2025 and potentially into the future, depending on how OPEC navigates bringing production back online. So I actually got to go meet with the OPEC folks in Vienna at the end of February, and they'll deny it in terms of how they're managing the oil price, or sorry, the oil market. There, I said it. They say that they're looking to make sure that the oil market is adequately supplied. But when you look at the history of OPEC cuts and OPEC production back online, you'll see that OPEC has fought to essentially protect an $85 price over the last few years. And if you look back further, you'll see that OPEC has really been looking for this sort of price on a inflation adjusted basis over the last number of years. And so here we are at a price close to $20 below what we've seen OPEC fight to try to achieve. And they would say, hey, we're trying to keep the market adequately supplied, but not oversupplied, and trying to sustain investment. And I would say, hey, that's fine to say that. And what that means from a market perspective and a price perspective is $85 plus oil, as we saw in a previous chart. We've seen the U.S. rig count collapse, frankly, in the last couple of years in response to oil prices being on average below $85 a barrel. And we're even seeing that happen internationally, where we're seeing the rig count falling. We're seeing expectations for demand for offshore rigs, both sort of more shallow water jackups, as well as the drill ships for deep water, demand disappointing, day rates lower than expected. And so we think the industry needs $85 plus oil. We think OPEC is generally acting towards that in order to maintain sufficient longer-term oriented investment in the oil and gas industry in order to be able to get the market adequately supplied. And I think they see the same risk that we do at Bison, which is that this long-term undersupply that we showed and long-term, underinvestment may lead to a price shock, which could actually be negative for long-term demand for oil and quite negative for the global economy. And I think it's a reason to try to get oil prices to or above $85 a barrel. And frankly, I think the Trump administration perhaps should be aiming towards either drill baby drill or um, the low oil price targets that they've shared. And I think realistically for the US economy, as well as to maintain balance in the oil market, it makes sense to actually aim for $85 plus WTI, um, inflation adjusted. So we really like this chart. I think we originally found this from Goldman, but this sort of four quadrant chart is quite common from a broad macro perspective as well as thinking about cyclical markets. And so um, we think we're in this period of low prices, which is actually hurting supply prospects and stimulating demand. And as we progress from this current period of low prices and underinvestment, we think there are going to be great opportunities for the equities, and we think it's quite attractive point for folks looking at buying both oil and oil-related equities. And again, keep in mind this is not investment advice, and we are not using this for a solicitation, offer, or recommendation. So now we'll go over to the natural gas market and then opportunities in oil and gas equities, and then close it up. So the US natural gas market it's pretty amazing when you look at it in the past decade how much production has grown by roughly 30 BCF per day, considering the low prices for the last decade and all of the different things that have happened in the world and in the broader economy. And one of the things that hasn't been happening recently is gas production hasn't grown recently, even though it grew quite a bit in the prior 10 years. And what seems to be expected when you look at the different power plants that are coming on and LNG facilities and so on, there is this call on sort of an incremental 30 BCF a day of production by the end of this decade, by 2030, which would be a much faster pace than we saw production grow by in the prior 10 years. But we're actually not seeing production grow by much right now. And so there's this big growing disconnect. We've talked about this extensively, and we are extremely bullish on the medium-term price for natural gas. We think prices need to go higher in order to incentivize production and in order to meet demand, predominantly from LNG export facilities, but also from AI data centers and from potential reindustrialization of the US and just growth in US consumption broadly. So the biggest driver really for incremental LNG demand in the US is this growth in export capacity that the EIA has been forecasting to see essentially double by 2030. And this is before the success with Plaquemines and Corpus Christi Stage 3, which you can see on this chart on the bottom left. And these things came on in less than 3 years, and they came on at a really attractive price relative to some of these earlier facilities. And I think that's going to lead to many more LNG facilities built. I think that part of Trump's economic plan and energy plan will be successful for the most part, especially if they figure out what's going on with these steel tariffs. And there's just an enormous spread, which you can see on the bottom right. This spread is narrowed very slightly recently, but it's still very wide and extremely profitable to export natural gas from the US to Europe and Asia. And even if Russian gas were to come back in some capacity to Europe, there may still be a quite wide margin, as well as some security and other motivations for Europe to continue to import increasing amounts of US liquefied natural gas. And so the window's open and the construction is underway, and we think more of these projects will get built, and they'll get built faster and cheaper than people are thinking. And we think there's a lot of upside to these numbers that the EIA is showing in terms of LNG demand, which we think is going to be the primary driver, and it may call more than 30 BCF a day incremental by 2030. So again, the fast build times matter quite a bit, and we could see close to this 30 incremental demand just from LNG projects if we look at what's under construction as well as projects that are approved and looking for final investment decision. And then we've seen a number of approvals in the last couple of weeks that we don't have on this chart that we think could get added and frankly could come on if they're built in the modular fashion that Plaquemines and Corpus Christi Stage 3 were built in. And that modular design is helpful for lower cost and for much, much faster build times. The build times are down 55% or so from 2014 to 2022 starting points. And we think that that may actually continue, maybe not at quite that same efficiency pace. And that's just extremely bullish for natural gas. And we're going to see tons more brought to new LNG facilities. And that spread, again, is very wide. So AI data centers, we've been somewhat skeptical of this. Obviously, it's wonderful to see incremental demand coming from these data centers, and there's more and more of them getting built. We don't think this is sort of a three-alarm fire sort of demand driver, similar to the LNG, where LNG you're seeing it getting built faster and more, and the numbers are enormous. The data centers are very big relative to prior sort of general cloud data centers and other use data centers, and even versus some of the cryptocurrency like the Bitcoin mines and so on. But it's still material, and to the extent that it continues, and looking at sort of some of the plans and the orders and various other drivers, there is potential for this to drive additional demand that could be quite material. It's just not something that we're counting on. So it's exciting, and there is a lot of upside, but I'm not relying on this to be right on natural gas prices rising and there being a material unmet call for natural gas going to 2030. The gas rig count has fallen quite a bit too, in addition to the oil rig count, and the frac spread count is down quite a bit. And so, both these numbers are important. And yes, there have been improvements in drilling efficiency, and yes, there have been improvements in pressure pumping efficiency, and there's more horsepower on these existing spreads. But there are limits, and as per foot well productivity is rolling, similar to oil, it's not falling quite as extremely as oil is on a per foot basis, but it's starting to roll, and in some basins you're starting to see declines. As that happens, you're going to need more rigs, not fewer, and you're just not seeing it in order to sustain production. And then in order to get this 30 BCF or more of incremental production, we think you're going to need to see much higher prices and then many, many more rigs active, both for oil and for natural gas. And then that lower oil rig count is a problem for gas too, because it means less associated gas coming from oil wells to go into the gas supply. So it's not just our view. Various executives from public and private natural gas companies have come out and talked about what they need to see in order to incentivize incremental activity. And sure, EOG is drilling a few more natural gas wells this year than last year, but not a lot. And when you look at the pure plays, especially on the Haynesville side, which is important because the Haynesville provided a lot of that incremental natural gas supply in the last few years, the executives are saying that they need $5 plus in order to spur substantial additional investment. And we think that additional investment is necessary in order to clear the market as we consider all of these different LNG projects coming on, as well as the AI data centers and broad demand growth. And frankly, if current trends continue, if you don't see a lot more gas rigs added soon, you could actually see this problem becoming more extreme. Like the longer it takes for the industry to respond to this and start adding gas rigs, um, the worse the undersupply could get, and then the more of these LNG facilities get approved and get funded and get built, and the faster they get built and the bigger they get, the more this problem uh, becomes acute. So now we'll talk a little bit about the opportunity in oil and gas equities and then close this up. So we see a lot of upside in particularly small cap oil and gas equities. Um, the market has done quite well in the last couple of years. Larger cap oil stocks have done okay, and small caps have done quite poorly. Updating this, rolling this forward even just a couple of weeks would show even further underperformance for the small caps and for larger energy equities with only a very small pullback in the broader market. We think that over time that in cyclicals you should look for material catch-ups for a cyclical in the equity in the share price movements to be able to incentivize investment. Everyone knows that cyclicals are cyclical, and so in order to get enough investment to be able to adequately and then eventually oversupply the market, you need the share prices to move up by so much relative to the broader market that they induce sufficient investment. And so far, we have not seen that, both over this couple year period as well as if you look back over the past 10 or more years. There's been an enormous lag in the small caps, in the services, and even the large caps in the energy space. And you historically have seen the small caps actually do the best in energy bull markets, which is, I think it's sort of a cyclical signal when they do the best for a multi-year period that it might be time to start reducing those positions. Similar on the services side, but when they underperform for a period of time, we think it's actually a good indicator that they may be well priced and compelling, and that there may be upside, enhanced upside versus the broader market and versus larger energy stocks for a period of time going forward. So sector outflows, I mean, it's no secret that energy's seen significant outflows, and then it shouldn't be a huge surprise to see that there are small caps that are trading at enormous discounts relative to various metrics, including free cash flow. And we think some of these stocks are just wildly cheap. In some cases, these are companies that actually have no debt and substantial net cash on their balance sheets, and that are paying dividends or buying back stock or doing additional acquisitions or growing quite rapidly. And so there's just a tremendous opportunity set that we see, and we're really excited to deploy capital here. That's part of a reason to share this, is just, we think it's really exciting. It's sort of odd how people treat stocks as something where when the price goes down, they want less of it, when the reality is that when valuations decline on businesses, frequently that's a lower risk and higher prospective reward time to buy them. And the converse is true as well. When share prices rise, people get more excited, not less, and they buy more of those stocks, not less. And that tends to be one of the more risky times to buy those stocks, and there tends to be a period of underperformance for high valuation companies, especially after recent share price gains, and there tend to be great opportunities where share prices have fallen and valuations have fallen and sentiment is quite low. And so we're quite excited, both because of the fundamentals for these businesses and where we're at in the cycle, and because of this long-term underinvestment in the industry, especially in exploration and delineation, that we think is going to be necessary to be able to get enough production, especially as shale slows down and goes into potential decline, at least decline at current prices. We think there's going to need to be a lot more investment. And in the meantime, we think companies that will be called upon to make those investments are radically cheap and extremely compelling. So with that, happy to answer questions. Please feel free to reach out. We appreciate you listening to these things. It's always fun for me to do them, and we'll look forward to catching you on the next one. And thank you very much.